Moving from accumulating wealth in pre-retirement to spending wealth in retirement requires a change in investment strategy, and the old strategies may be dead. Taking a deep dive into the popular 60-40 portfolio on this week's Fastest 4 Minutes in Finance. Hello again, I'm Scott Inman. Well, is the 60-40 portfolio dead? It's certainly not a new question, but the economic environment we find ourselves in has prompted several bank analysts to recently declare a resounding yes. So let's start with defining what a 60-40 portfolio is. It is the financial services industry standard of allocating 60% of your assets to equities in the form of individual stocks, ETFs, or mutual funds, and 40% of your portfolio to fixed income in the form of bonds. This generic thought process assumes that the fixed income component will offer stability to your portfolio when the stocks are volatile. It also expects bonds and stocks to oftentimes move in opposite directions, and that the total return over time will support an arbitrary withdrawal percentage for you in retirement. Now, this basic strategy was popular when interest rates were much higher than they are now. And with interest rates falling for decades, the prices of those bond funds were going up. The problem we find ourselves in now is a low interest rate environment with a higher than average inflation rate. That is likely to push interest rates higher, but have a negative impact on the bond prices. And that could create more volatility on the so-called stable portion of your portfolio. Now add to that there's talk about stagflation on the horizon. That's when high inflation is coupled with low economic growth. We haven't experienced that since the 1970s, and it is certainly debatable whether that is about to happen again. But if it does, your 60-40 portfolio could suffer even more. And an added note here, for most of the clients who come into our offices for the first time, most of their wealth is in their 401k or employer retirement plan, and often it is invested in target date funds. These funds have become popular because they allow you to choose your year of retirement, and as you get closer to that date, the fund allocates a larger position to fixed income. As an example, if you are in the 2025 retirement fund, you may have an allocation to fixed income that is even larger than 40%. Last week, remember those bank analysts? Well, they suggested possible solutions to the 60-40 conundrum. But those solutions are often very complex. For instance, Goldman Sachs suggested using stock options to insure against market risk. I'm not really sure that that's a possibility for the average retiree. Most people who retire are ready to enjoy their lifestyle and not spend every day making decisions about their portfolio. So what's the takeaway here? Well, bottom line, simple asset allocation strategies may not be adequate to provide retirees with the retirement income they want, and may not ensure that they don't run out of money before they run out of time. All bonds are not created equal. There could be certain types of fixed income that hold up better in a rising interest rate environment. Working with a financial advisor and building a retirement income plan can provide clarity and operate with more precision than simply following the 60-40 rule. Changing economic conditions call for changing the way you think about investing, especially if you're about to retire. Thanks for watching.